Are we looking at fundamentals now more than some of the macro factors we have been?
Yeah, look, I think Mike got it right this week. Certainly, markets were driven by those earnings results, and really the earnings results from the mega cap technology names. And as you noted, they surprised to the upside. And that wasn't only earnings beats. A lot of them are now showing that their business models are resilient, even through economic swings. And also, they are showing off a little bit of their cash piles. We saw a couple of very big share buyback programs announced this week as well. And we saw at the end of the week, really, equity markets were bullish. They were positive for the week. And that came even despite softer than expected GDP data, inflation data that might be a little bit stickier than some might have hoped for. So generally, for the last couple of weeks, it certainly has been the earnings story driving markets and really driving those growth sectors in particular. But as we look towards the weeks ahead, especially next week when the Fed becomes more in focus again, and as the economy and inflation continues to remain to the forefront, I think we'll see a swing from earnings and equity fundamentals to macro picture becoming more in focus in the weeks ahead as well. But so certainly right for this week.
Greg, what's driving the fixed income markets?
It is inflation, the economy, and what is the Fed going to do about it? So we're on knife's edge in fixed income, whether it's a recession or a soft landing. There's talk of stagflation still, of course. And the data are so all over the place and dispersed that you can basically draw a narrative or a conclusion from the data in any way you want.
Well, so I'm curious about that because the 10-year yield, at least to my eye, has not been going much of anywhere anytime soon. Is that because people are happy with where it is, or it's because they can't just decide? Any way they look, it could go either way. They just can't tell. Yeah,
and so that masks, what's underneath. And so what we're seeing, though, on an intraday basis, interweek, the moves are pretty extreme. So fixed income volatility remains really, really high. So yes, the 10-year is virtually unchanged this month of April, but the swings are pretty substantial.
And Mona, what about in the equity markets? What are we seeing? The VIX is pretty subdued, is it not?
Yeah, it really is one of the key stories that has emerged over the last few weeks, which is that volatility index, some call it the Wall Street fear gauge, has been very subdued. In fact, down about 25% year to date, which shows a bit of complacency from the markets and perhaps a little bit of investors hiding out. Keep in mind, cash and cash equivalents are offering attractive yields. So if investors do want to wait for better opportunities, they certainly have an alternative now that is a pretty attractive alternative. But generally speaking, some of the catalysts that were supposed to emerge early on this year, including earnings, including the Fed potentially next week, and including this economic downturn, really haven't yet surprised in any material way. And so I do think markets have yet to see a meaningful catalyst. Perhaps the Fed pause that may be on the horizon will be that one.
Well, Mona, what about the possibility of recession? Because we still have a lot of economists saying that it's more likely than not, perhaps as high as 70% likelihood. I don't think I can see that very much in the equity markets. So do the equity markets know something the economists don't, or do the economists know something maybe the equity markets don't?
Yeah, look, I think this recession that is on the horizon is probably one of the worst kept secrets that's out there among economists and investors. Everybody has been talking about it. The deceleration we saw this past week in first quarter GDP has shown a slowdown from 3.2% in Q3, 2.6% in Q4 of last year. This quarter, 1.1%. So we're seeing this downward trajectory. The consumer is still holding up. But if you look at forecasts for Q3 and Q4 of this year, we are, in fact, seeing negative and slightly negative annualized growth rates. So in our view, this idea that a mild recession is on the horizon is very likely still, probably still a base case scenario. And markets won't be able to completely ignore that. But keep in mind, we did put in a lot of work to the downside over the last 15 months or so. The S&P went down almost 25% peak to trough. We don't see a repeat of that happening, even if we have a mild recession ahead. So any period of volatility, consolidation, pullback, we think could provide some opportunities for investors as they look past this bear market and perhaps towards a recovery period ahead.
Greg, what about the bond markets? Because we got a lot of economic data out this week, and it showed sort of slowing growth, perhaps. But inflation is not going away. Maybe headed in the right direction. It's not going away. Are the bond markets prepared for the possibility of the Fed hiking even past May?
No, in fact, the market's pricing in the opposite, right? They're pricing in rate cuts in the back end of this year. And to me, that is, the risk markets are ignoring that if the Fed cuts, that means we are into a recession or a much weaker period. But the binding constraint continues to be inflation. And I think we're in a very different environment. We've been so accustomed to the Fed coming to the rescue, and it's much easier to do that when they're operating below that 2% level. When they're above, and they're pretty meaningfully above, their degrees of freedom really get much tighter. So I think the markets are miscalibrating what the Fed can do. And the opposite is also true, David, where if the numbers continue to assert themselves on the inflation side, there's more work to do. And the markets have been consistently wrong on the level of inflation and what the Fed's response function.